In 2018, Toys R Us filed for bankruptcy. 33,000 people lost their jobs. The company owed $5 billion in debt, but here's the strange part. The three private equity firms that own Toys R Us walked away with nearly $2 billion in profit. You might be wondering how that's possible. How do you extract billions from a company that's collapsing? And more importantly, why would anyone design a system that rewards this? The answer is buried in a corner of finance that most people never see. It's not illegal, it's not a conspiracy, it's just math, very uncomfortable math. Private equity controls $6 trillion in assets globally. That's roughly the GDP of Japan. These firms buy companies you've heard of: Red Lobster, PetSmart, Hertz, hundreds of nursing homes, hospital chains, even your local veterinary clinic. The pitch sounds reasonable. A private equity firm tells investors, give us your money, we'll buy underperforming companies, fix them, and sell them for a profit. Everyone wins. And sometimes that's exactly what happens. But there's another version of this story, one where the company dies, workers lose everything, and the private equity firm still makes a fortune. That version isn't a mistake, it's the model. Let me show you how it works using a fictional company. Let's call it Megamart. It's a mid-sized retail chain, decent sales, stable workforce, nothing flashy but profitable enough to survive. A private equity firm decides to buy Megamart, but here's the first trick: they don't use their own money. They put down maybe 30% of the purchase price. The rest they borrow. Let's say Megamart costs $1 billion. The private equity firm puts in $300 million. They borrow $700 million from banks. Now here's where it gets weird. That $700 million in debt, they don't keep it. They transfer it to Megamart. The company that was just bought now owes $700 million it didn't owe before. The private equity firm bought the company with the company's own future. Think about that for a second. Imagine someone buying your house, taking out a massive loan to do it, then telling you that you're now responsible for paying back that loan. That's essentially what happens. This is called a leveraged buyout. The leverage is debt. And it's perfectly legal. Megamart now has debt payments to make, big ones. The private equity firm steps in with a solution. They'll help the company optimize operations. That usually means three things. First, mass layoffs. The workforce gets cut, experienced employees disappear. The remaining staff works harder for the same pay or less. Second, asset sales. Megamart owns its stores. The private equity firm sells the real estate to another company they control, then leases it back to Megamart at a higher rate. Megamart gets a temporary cash injection. The private equity firm gets another income stream, but now Megamart is paying rent on property it used to own. Third, management fees. The private equity firm charges Megamart millions of dollars per year just for the privilege of being owned by them. Consulting fees, advisory fees, monitoring fees, these aren't optional, they're baked into the deal. So now Megamart is bleeding from three wounds: massive debt payments, higher rent, and management fees it never had before. But the private equity firm isn't done. Here's the move that makes private equity so controversial. Even though Megamart is struggling, even though it's loaded with debt, the private equity firm decides to pay itself a special dividend. They have Megamart borrow even more money, not to invest in the business, not to innovate or expand, just to pay the private equity firm a lump sum, sometimes hundreds of millions of dollars. This is called a dividend recapitalization. It's how private equity firms make their money back before they even sell the company. They've already recouped their initial investment, sometimes twice over, and they still own the business. Megamart, meanwhile, is drowning. The debt is unsustainable. Sales are declining because the stores are understaffed and outdated. Suppliers start demanding cash upfront because they're worried Megamart won't survive. And then, inevitably, Megamart files for bankruptcy. When Megamart collapses, thousands of people lose their jobs. Vendors lose millions in unpaid invoices. Landlords lose tenants. Communities lose a major employer. But the private equity firm? They've already taken out more than they put in. The dividend recaps, the management fees, the real estate sale. Even if the company is worth zero at the end, the private equity firm can still walk away with a significant profit. This isn't theoretical. A study from the University of Chicago found that private equity-backed companies are 10 times more likely to go bankrupt than comparable public companies. Not because they were doomed from the start, but because the financial engineering made them fragile. Another study tracked retail bankruptcies between 2009 and 2019. More than half were companies owned by private equity firms. Payless, Jimbicor, Brookstone, Barneys, the list goes on. The industry argues that they're buying distressed companies that were already failing, and sometimes that's true. But the data shows a pattern. Healthy companies get purchased, loaded with debt, stripped of assets, and pushed to the edge. The fact that some survive doesn't erase the ones that don't. If you ask a private equity executive about this, they'll tell you a different story. They'll say they create value. They'll point to successful turnarounds. They'll argue that failure is just part of capitalism. And they're not entirely wrong. Private equity does save some companies. They do force bloated organizations to become more efficient. There are genuine success stories, but the incentive structure rewards extraction over preservation. The faster a private equity firm can pull cash out of a company, the better their returns look to investors. And since they're playing with borrowed money, the downside risk is limited. If the company fails, the banks and bondholders take the loss. The private equity firm has already cashed out. It's a system where heads they win, tails someone else loses. This isn't a niche issue. Private equity firms employ 12 million people in the United States alone. 1 in every 12 American workers is employed by a private equity-backed company. That veterinary clinic where you take your dog, there's a decent chance it's now owned by a private equity firm. Same with your dentist. Your dermatologist, urgent care centers, ambulance services, nursing homes. A 2020 study found that when private equity firms buy nursing homes, patient mortality rates increase. Not because the firms intend to kill people, but because cost-cutting measures reduce staff and quality of care, fewer nurses per patient, cheaper food, deferred maintenance. The math works for the private equity firm. It doesn't work for the elderly woman in room 214. Here's the uncomfortable part. The money funding these private equity firms often comes from pension funds, university endowments, and insurance companies. In other words, regular people's retirement savings are being used to buy companies that then lay off regular people. Your 401k might be invested in the very firm that just closed the factory in your town. The pension fund manager will defend this by saying they have a fiduciary duty to maximize returns, and private equity on paper has delivered strong returns for decades, but those returns are increasingly being questioned. A recent analysis found that after accounting for fees and risk, private equity returns aren't actually better than public stock market returns. They just look better because of the way the numbers are reported. Private equity firms report their returns using something called internal rate of return. It sounds technical, but the key thing to understand is that it can make returns look better than they actually are. Public stock returns are marked to market every single day. You know exactly what your investment is worth. Private equity valuations are subjective. The firm decides what their portfolio companies are worth, and they only update those valuations periodically. This creates an illusion of stability and strong performance. But when researchers compare apples to apples, adjusting for these reporting differences, the outperformance largely disappears. And even if the returns were exceptional, there's a deeper question: at what cost? So why doesn't the government stop this? The answer is complicated. First, it's not always clear when a private equity deal is predatory versus genuinely trying to save a struggling business. Drawing that line is hard. Second, private equity firms are politically powerful. They donate to campaigns. They hire former regulators. They lobby intensely against any rules that would limit their leverage or transparency. Third, and perhaps most importantly, bankruptcy law in the United States is debtor-friendly in theory but creditor-friendly in practice. When a private equity-backed company goes bankrupt, the firm itself usually isn't liable for the debt it imposed on the company. The corporate veil protects them. There have been some legislative attempts to change this. Proposals to make private equity firms liable for the debts of their portfolio companies, rules requiring more transparency in fee structures. Restrictions on dividend recaps. None have passed. The closest thing to reform came in 2020 when Senator Elizabeth Warren introduced the Stop Wall Street Looting Act. It would have made private equity firms liable for pension obligations and damages from their portfolio companies. It would have restricted dividend recaps. It would have given workers and creditors priority over private equity fees in bankruptcy. The bill died in committee. Private equity is a symptom of something larger. It's what happens when financial engineering becomes more profitable than actually building things, when the incentive is to extract value rather than create it. You can see this pattern across the economy. Companies buying back their own stock instead of investing in research. CEOs optimizing for quarterly earnings instead of long-term growth. Entire industries financialized to the point where the product becomes secondary to the profit mechanism. Private equity just does it more efficiently and with more leverage. There's a term in economics, rent-seeking. It means extracting wealth without creating value. You're not making a better product or inventing something new. You're just positioning yourself to take a cut of existing economic activity. Private equity at its worst is industrial-scale rent-seeking. The leverage multiplies the extraction. The fees create a constant drain. The dividend recaps pull forward all future value into immediate cash. And because the system is designed to shield private equity firms from downside risk, they can play this game repeatedly. One portfolio company fails, they've already made their money, move on to the next one. The wildest part of this story isn't that private equity firms profit from destroying companies. It's that the system is designed to let them do it legally, repeatedly, and with very little consequence. Toys R Us is gone. But the three private equity firms that owned it, KKR, Bain Capital, and Vornado Realty Trust, are still operating, still buying companies, still using the same playbook. In 2021, there was a small moment of accountability. The three firms agreed to contribute $20 million to a fund for former Toys R Us employees. $20 million sounds like a lot until you remember they extracted nearly $2 billion. It's 1%, a rounding error. So here's the question nobody seems to want to answer. If a business model requires companies to fail for investors to succeed, is it really capitalism? Or is it just extraction dressed up in a suit? The classical defense of capitalism is that it's efficient. Resources flow to their best use. Good companies thrive, bad companies fail. Everyone benefits from competition and innovation, but that only works if the incentives are aligned. If you can make more money destroying a company than building it, the system breaks down. And that's where we are. The math says one thing, the jobs say another. And somewhere in that gap, 33,000 toy store employees are still looking for an answer.